This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, what Blackrock CEO just said is outright terrifying. And what I want to understand is why Larry Fink says we're on the edge of a massive crisis, and that if immediate action isn't taken, that it will affect investors for decades to come. And when you see the recent incoming U.S. manufacturing data, you're going to find out why we're much closer to this next crisis than most people believe. Plus, we have a sponsor of today's show. Enduro Clean Technologies is back. Now, keep in mind the last time they were on the show was September 5th of last year. Since then, the stock is up 41.6%. And is right now, if you're a technical trader, the stock is coming to an end of a symmetrical triangle, which is a continuing pattern, meaning their stock is about to make a big move higher. You can find it on the CSE under symbol ACT or on the OTCQX under symbol ACTHF. If you missed the first one, you don't have to miss the second move. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where he picked today's story up with a headline as Larry Fink calls on boomer generation to fix this impending retirement crisis that he suggests we need action, and action now. With people living longer lives but struggling to afford them and plan property, what we know is that Fink says an organized high-level effort to rethink the retirement system is needed. After all, more than half of BlackRock's $10 trillion client assets are managed for retirement, suggesting that all of this money is concentrated in one group of people, leaving many others behind. They believe my generation, the baby boomers, have focused on their own financial well-being to the detriment of who come next. And with the case of retirement, he says, well, they're right. And when you look at the economy, well, it's going to show you, and you'll understand why what's coming will affect investors for generations to come in a very bad way. He says young people have lost trust in older generations. The burden is on us to get it back, and maybe investing for their long-term goals, including retirement, isn't such a bad place to begin. The problem is we have investors piling into U.S. equity markets at what could be one of the worst possible times in their life. And when they have a massive negative experience, as we're likely to see based on the recent U.S. manufacturing data, well, it's going to affect them for a very long time. The shift from defined benefit to defined contribution has been, well, for most people, a shift from financial certainty to financial uncertainty, which is coming in a big way. As we now head over to Texas, we see the manufacturing activity weakness in March has gotten worse as Texas factory activity weakened in March after stabilizing last month, giving people hope. The production index, a key measure of state manufacturing conditions, fell 5 points to minus 4.1. A reading suggests a slight decline in output month over month. Other measures, well, they declined as well. We see new orders, a key measure of demand, drop 17 points to minus 11.8 after briefly turning positive last month, and again giving people hope. How about capacity utilization? Well, that edged down 5 points into contraction to minus 5.7, and shipments plunged from 0.1 to minus 15.4. And yet the broad belief now is the U.S. equity market is going to continue to go higher. But as we look around the world, particularly at the U.S. manufacturing sector, which has been one of the best compared to all the other major nations, what we're seeing is a big shift to the downside. And we know, well, of course, when things in Texas go wrong, it has everything to do with crude oil. And what this means is that $80 a barrel, as you can see in form of West Texas Intermediate shown in red, the prices for crude oil are not high enough to sustain Texas economy. And sure enough, what do we see? The current new orders diffusion index for Texas, after a brief run to positive territory, is headed down and likely to head lower. And you can see the strong relationship with oil prices. And of course, what we see is new orders in Texas. If we do end up seeing a leg down in oil, well, that means things for Texas, as you're about to see, and the rest of the U.S. economy, going to get far worse. Labor market measures suggested slower job growth and shorter work weeks to come this month. The employment index remained positive for a second month in a row as employers still hired on net, but of course that means hours worked remained negative for a 6th month in a row and held fairly steady at minus 7.9. So we know employers are cutting hours, and that is usually the beginning phase of what eventually comes into more layoffs. And I want you to see how well this correlates what's going on in Texas as we go back to the current new orders index. Again, this is the Fusion Index for Texas. It gets average weekly hours worked for production and non-supervisory employees now in the manufacturing sector. That's shown in red. And what you can see is downturns in new orders usually follows a downturn in hours worked. And we know where hours worked eventually goes, layoffs follow. And you can see there was some hope there was an upturn here in new orders, but what's happening, that is going away quickly and hours worked continues to decline. And look what people are saying in Texas. A business is only good as its customer's business and is completely dependent on its customer's demand. And demand, well, it's weak. And we keep thinking orders would pick up in the first quarter, but they have not. In fact, they've gotten even fewer and further apart. In fact, this suggests that a stronger, deeper recession is publicized is happening. And we're seeing general business activity slowing and competition increasing. Never a good sign as people fighting over scraps. And while there's no disclosures, we're in a recession. Ask any manufacturer on the globe, and they'll tell you we're deep into it. A soft landing is far from the truth out there, and this is dangerous because what we're seeing is young investors trying to play catch up in a big way, taking risks in the equity markets. And well, as you can see, it generally doesn't play out. As we know, going back to Texas new orders being a proxy for where the equity markets are headed, you can see against the Wilshire 5000 or total U.S. stock market. What this means is as new order demand declines, well, stocks usually follow in suit. Here we have a case where everyone believes stocks are going higher, and not just a little bit, a lot higher. That what we're hearing from Texas manufacturers is demand is getting worse and in a big way. In fact, if we head over to the 5th District, what we know is that Richmond has the same issue, that manufacturing activity slowed in March. This is a trend now that's building among the regional Fed surveys, and this you're seeing is dangerous news for the U.S. economy. You start to understand why young people who already don't trust the boomers, as Fink has mentioned, will wait till they see the equity markets come down, and they'll be now decades behind, on top of the fact that they're going to lose all out confidence in the markets. Here we can see the composite manufacturing index decreased from -5 in February to -11 in March, suggesting further slowdown as shipments remained solidly negative. New orders fell from -5 to -17, and get this, employment stagnated now at 0. And firms were split about local business conditions as the index hovered around 0. But look at this. Most firms continue to report declining backlogs, and we know that as new orders and backlogs go down, well, that means hours worked, and eventually layoffs start to go up. And as the index remained negative, the vendor lead time index returned to negative territory. The capacity utilization index fell from -4 to -21. And what capacity utilization is, what percentage of a factory is being utilized. Well, the less you see capacity utilization going, well, that is not a good sign, because as demand for the factory goes down, well, so too does hours work. Here we're bringing back now average hours, weekly hours of production of non-supervisory employees for the manufacturing sector against capacity utilization, that shown in blue on a percentage. And here you can see going back to the 1960s, there's a very strong relationship that as capacity for factories declines, so too does hours worked. Eventually, hours worked gets low enough where manufacturers start to lay off and continue to keep people on the unemployment line. This again signaling danger signs for the U.S. economy and, of course, the U.S. equity markets, as we'll further look at. And notably, as I mentioned, continued claims, almost a mirror of capacity utilization. We continue to hear from Federal Reserve Chair Jerome Powell that the U.S. labor market is strong and robust, but the factory sector is telling us otherwise. In fact, we hear from these political elites that they believe that the temporary increase in claims is going to be reversed in a big way. But as we look around these regional Fed surveys and we look at capacity utilization, we see that there's no signs of a change in this trend. In fact, unemployment claims likely to continue higher in the months to come, putting the whole U.S. economy on ice for the next recession by the end of the year. And here you can see the relationship between capacity utilization and the Wilshire 5000 price index. We can note that declines in factory capacity match perfectly with declines in the U.S. equity market, except now, again, as investors bull up in a big way, looking to think the stocks are going to just go off the chart. Meanwhile, the factory sector says, wait a second, things here in the economy for the U.S. is not going that well. And again, you start to think back what Fink was saying about these young investors that just don't trust because of the system, and they're going to face job losses. They're going to face competition as older people come back into the workforce. They're going to see their investments wiped out. It's going to change everything for the rest of their lives. This will be decades-long crisis, and not in a good way. But the government continues to give us hope, at least hope because, well, the official data looks better than the survey data. As U.S. durable goods orders rise for the first time in 3 months, this, of course, not really as good as it sounds. Bookings for all durable goods, items meant to last 3 years or longer, increased 1.4%, following a downwardly revised 6.9% drop in January. Talk about a big tumble. The median estimate was for a 1% increase, and excluding transportation equipment, orders rose 0.5%. After falling the 2 previous months. So based on the Fed survey data, you get the impression that things from the manufacturing sector are indeed getting worse. You look at the headline government data and you say, wow, things are getting better. The question is, who's right? Well, here's what we can note. The capacity utilization numbers are indeed correct here, and manufacturers' new orders, well, they are noisy. They do go up and down month to month, but the trend now is lower. And what we're hearing again in Texas and Richmond is demand at the manufacturing level is declining. You see that in capacity utilization slowing down throughout history. And what that means is new orders, while they popped up this month on a year-over-year rate of change, are not likely to buck the trend going lower. You see that horizontal green dashed line? That's the level of contraction we will expect in the months to come here. Possibly within 1 to 2 months, we'll see the official government data follow. But yet, we continue to know that despite all of the reality of the slowing economic data, consumers are starting to buy in that the U.S. economy is indeed slowing. That there's one thing that remains that they're super bullish on. If you're thinking the stock market, you got it. U.S. consumer confidence was a little changed in March. This from the Conference Board, as brighter perception of today's economic conditions eclipsed by rising anxiety about the future. Of course, why would investors or why consumers would have anxiety when they believe the equity markets are going higher? Because indeed, higher equity markets should translate into bigger spending as the wealth effect kicks in. But when that doesn't happen, it's a huge red flag for the economy. Let's see what consumers are worried about, because expectations for the next 6 months. Now, keep in mind, what do we keep hearing over the next 6 months? That the soft landing will materialize, or the no landing scenario in the second half of this year is going to be lights out fantastic. Well, consumers aren't buying it anymore. It's now slipped to the lowest level since October of 2023. As outlook for future business conditions, labor market conditions, and income expectations all deteriorated in March. They were also a little less optimistic about their family's financial situation, both currently and over the next 6 months. Yet sentiment about stock prices over the year ahead continued to strengthen. The share of consumers expecting an increase in interest rates over the year ahead rose above 50% for the first time since November of last year. But get this, you talk about the economy, talk about needing to see the case for higher equity prices on a 6-month basis, buying plans for interest rate sensitive items like autos, Homes and big ticket appliances dipped yet again, suggesting that that new order data that the government's putting out is likely to turn down in a big way. But here you can see, if you look at recession odds, consumers aren't buying it. They're looking at the equity markets, not the economic data, and they're seeing the perceived likelihood of U.S. recession go from somewhat to less likely. Now that number is declining against the fact that confidence for stock prices is shooting back up to right where it was between 2016 and 2017, suggesting that regardless of where the economy goes, consumers believe that U.S. stocks are now at a permanently high plateau and can only go up. But yet, when you look at consumer confidence data, well, the math doesn't entirely add up. Usually when you see consumer sentiment decline, here shown from the University of Michigan, that usually correlates with a decline in stock prices. This time, we're seeing the 6-month data of confidence start to roll over and head down. At the time, consumers remain very bullish. Well, I'll tell you what, there's one thing consumers should be bullish about, and that is the stock for our sponsor for today's show, Aduro Clean Tech. Now, keep in mind, we featured them on the show back on September 5th of last year. Stock up 41.6% as of recording, and right now sitting at the end of a symmetrical triangle, suggesting it's a continuation pattern that the stock is about to break out in a big way. You don't want to miss out on that on the CSE under symbol ACT and on the OTCQX under symbol ACTHF. Everything you need to know in the pinned comment and description below. And Aduro, they are the power of between what is complex and what is simple. Sustainable transitions is all they're about, and powered by chemistry. Their technologies have the potential to make more plastics recyclable, heavy oils more environmentally sustainable, and renewable fuels more cost effective, and they are just getting started. They're upgrading bitumen, upcycling plastics, and upgrading renewables, and their technology platform means we don't have to choose between the benefits of modern life and an environmentally sustainable future. In fact, they just welcomed global multinational food packaging company into their customer engagement program. MFP is a prominent player in global food processing and distribution, boasting an attractive portfolio of well-known brands. It operates in over 15 countries and generates multi-billion-dollar annual revenue. And at its core operations, MFP integrates environmental, social, and government ESG principles, focusing on innovation and efficiency. The company is dedicated to recycling or recovering 90% of its solid waste and aims to reduce plastic use, increase the use of biodegradable and recycled materials, and minimize the use of virgin plastics. All of this is going to be a big boom, of course, for Aduro Clean Tech. And with that, let's take a look at what's going on with their stock. This is setting up a monster move. You don't want to miss out on the CSE under symbol ACT, on the OTCQX under symbol ACTHF. Here you can see a symmetrical triangle pattern. This from Investopedia represents a period of consolidation before the price is forced to break out or break down. It is notably a continuation pattern, so when you see stock prices heading down, it usually means they're heading down more. In this case, with Aduro, it's bullish as stock prices rose into the symmetrical triangle and are now coming near the end, looking to break out. Let's take a look. You can see this chart here on the 1 year going back, and we note is this beautiful symmetrical triangle. I've drawn in a line. We'll zoom in where, of course, the volume is holding here, suggesting that a breakout of roughly $1.06 from the current level, giving an excellent entry point. Just put your stop losses a bit down here below to give yourself some protection. But let's zoom in, and here you can see that beautiful symmetrical triangle, suggesting, as we know, over the last 90 days, look at the volume here. That's where all the buyers keep coming in at, suggesting this is indeed a continuation pattern, looking again for a breakout over 106, giving you the early opportunity to get in before the next big move. Again, you can find them on the CSE under the symbol ACT, on the OTCQX under the symbol ACTHF. And as always with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.